They said Bitcoin would set you free. Free from banks, free from governments, free from the system that keeps printing money, drowning the poor in inflation while the rich swim in liquidity. But freedom, as history teaches, is never free. Because when you remove the rules, the referees, and the regulators, what you're left with isn't paradise. It's chaos disguised as opportunity. This is the financial historian, where money, power, and history collide, and nothing is ever as simple as it looks. To understand Bitcoin, you have to go back to 2008, a year when trust itself collapsed. The financial crisis exposed the system for what it was, a rigged machine running on leverage and illusion. When Lehman Brothers fell, the entire world realized that the people in charge had no control, and worse, no accountability. Central banks printed trillions to rescue the very institutions that caused the disaster, while ordinary citizens lost their homes, jobs, and savings. It was a moment of collective disillusionment, proof that the financial order wasn't built on stability, but on faith. And in the middle of that global breakdown, on an obscure mailing list of computer scientists, a user named Satoshi Nakamoto posted a 9-page white paper. It was titled Bitcoin, a peer-to-peer electronic cash system. The idea was revolutionary and deeply political, a currency without a state, transactions verified by cryptography, not bankers, a supply capped forever at 21 million coins, no central authority, no inflation, no manipulation. The system would be open, transparent, and incorruptible. Every transaction would be recorded on a public ledger called the blockchain, a financial history that could never be rewritten. It was the perfect response to the sins of 2008, a monetary rebellion wrapped in math. In 2009, the first block was mined, the Genesis block. Hidden inside it, Satoshi left a message. The Times, 03 share Jan, 2009 Chancellor on brink of second bailout for banks. It wasn't just a timestamp. It was a middle finger to the system. But what did mined even mean? In the world of Bitcoin, mining isn't digging in the ground. It's solving complex mathematical puzzles. Every time a miner's computer cracks one of those puzzles, it adds a new block of transactions to the chain, the blockchain, and earns new Bitcoin as a reward. It's how the network stays alive. Thousands of machines competing, verifying, and securing every transaction without a central authority. No government, no bank, just math. Early believers joined the movement. Libertarians, programmers, economists, anyone who thought money should be free from political hands. They traded on small online forums, sending coins worth pennies. One of them, Laszlo Hanyecz, made the first real-world purchase. 2 pizzas for 10,000 BTC. At today's price, that's over $600 million, the most expensive meal in history. But soon, the idea of stateless money collided with human nature. By 2013, Bitcoin's price had exploded from under $1 to over $1,000. Speculators poured in. Exchanges like Mt. Gox became billion-dollar markets overnight. And then, as always, the dream cracked. In 2014, Mt. Gox collapsed after 850,000 Bitcoins vanished. $450 million in digital gold, gone with no one to call, no regulator to intervene, no refunds, no recourse. The blockchain recorded every stolen coin in public view, but not one could be retrieved. The technology worked perfectly. It was the people who failed. That's the paradox of Bitcoin. It removes the middlemen, but also the mediators. There's no authority to turn to when something goes wrong. Every transaction is final, every mistake permanent, and as the wider crypto world exploded, so did the scams. Fake wallets, Ponzi tokens, phishing links, rug pulls, most of them orbiting around Bitcoin's brand, but built on far shakier ground. In 2022 alone, users across the crypto industry lost over $3.8 billion to hacks and scams, the highest figure on record at the time. Even if you could trace the stolen funds, and you can, thanks to the transparency of the blockchain, recovering them is nearly impossible. The addresses are visible. The owners are not. Cold storage, hardware wallets like Ledger or Trezor are safer, yes, but not foolproof. They protect against hacks, not against fraud. Once you willingly send coins to a scammer, your hardware wallet can't save you. That's the trade-off Bitcoin forces. Freedom or protection. You can't have both. Bitcoin promised liberation from centralized control, and it delivered. But it also stripped away the safety nets that ordinary investors rely on. No chargebacks, no customer service, no oops button. You own your money and every mistake that comes with it. And yet, people kept believing. Because Bitcoin wasn't just money, it was ideology, a protest against the old order. And in that difference lies the whole story of stateless money. Because freedom without boundaries doesn't stay free for long. In 2021, one country decided to take the dream of Bitcoin and make it law. El Salvador, a small Central American nation long dependent on US dollars and remittances, announced that Bitcoin would become legal tender, Its young president, Nayib Bukele, called it a revolution. For the first time, a nation would use a stateless currency, a digital alternative to a financial system that had excluded millions. The world called him reckless. He called it freedom. At first, the story looked like a triumph. The government created a national wallet app called Chivo, handed out $30 in Bitcoin to every citizen who downloaded it, and installed Bitcoin ATMs across the country. Streets near El Zonte, dubbed Bitcoin Beach, became symbols of financial innovation. Tech influencers called Bukele the CEO president. For a moment, it felt like a new era. But the experiment hit the hard wall of reality. Most Salvadorans didn't want a volatile asset for their groceries. They wanted stability. In 2022, when Bitcoin's price plunged more than 60%, the government's holdings lost half their value on paper. Protests erupted in San Salvador. Citizens complained about technical glitches, scams, and frozen wallets. The IMF warned that adopting Bitcoin could destabilize the country's finances and cut off loans. By 2025, the results are mixed and revealing. El Salvador officially holds around 6,240 Bitcoins, worth roughly $740 million at today's prices, a paper profit of nearly $443 million after the recent surge. The government proudly displays that figure, but the reality is more nuanced. Only about 8% of Salvadorans use Bitcoin regularly, according to surveys by the Central Reserve Bank. The rest stick to dollars. Under a new $1.4 billion IMF agreement, Bukele's government quietly agreed to make Bitcoin acceptance voluntary rather than mandatory. The law remains, but the enthusiasm has cooled. International creditors forced restrictions on further Bitcoin purchases, though the country's Bitcoin office still buys small amounts off the books through state-linked entities. The Bitcoin beach economy survives, mostly fueled by tourism, but everyday citizens are wary. For them, Bitcoin didn't bring freedom. It brought confusion. Their salaries are still paid in dollars, their debts denominated in dollars, their savings in cash. Bitcoin for now is a sideshow. And yet, for all its flaws, El Salvador revealed something profound. Bitcoin can't replace the financial system, because it isn't a system. It's a technology. It works beautifully for those with knowledge and discipline, but as a national currency, it exposes the very thing it tried to fix: inequality. The wealthy and tech-savvy gained new ways to move money offshore. The poor were told to download an app that barely worked. What El Salvador discovered was that the stateless currency still needs a state to enforce trust. Without governance, adoption breaks down into chaos, and chaos has a cost. While the Salvadoran experiment played out in the real world, online, a new class of digital elites was quietly shaping Bitcoin's destiny. Not governments, but whales. Whales are the largest holders of Bitcoin, wallets that contain thousands or even tens of thousands of coins. In 2025, roughly 1% of all Bitcoin addresses control over half of the total supply. That means a handful of individuals or institutions can influence the price of an asset that markets call decentralized. When a whale moves just 10,000 BTC, around $600 million at current prices, it's enough to crash or spike markets across the globe. Some of these wallets belong to exchanges, others to anonymous entities. None are accountable. In traditional finance, this kind of influence would raise alarms. Regulators like the SEC or FCA monitor insider trading, market manipulation, and coordinated moves. If an executive buys stock before releasing good news, that's insider trading. If a hedge fund spreads false rumors to push prices down, that's market manipulation. Both can lead to prison sentences, but in Bitcoin, there are no such rules. No reporting requirements, no disclosure standards, no punishments. If a whale dumps coins on one exchange to trigger panic, then buys back cheaper on another, it's just strategy. Even more common is the insider game. Employees at exchanges knowing which coins will be listed next and front-running the market. Developers leaking information about updates. Private groups coordinating pump and dump cycles through encrypted chats. In regulated markets, this would be criminal conspiracy. In crypto, it's Tuesday. That's the contradiction at the heart of Bitcoin's story. It was built to remove human corruption, but humans built everything around it. And those humans learned to bend the rules, because there aren't any. Bitcoin can't be manipulated by governments, but it can be, and is, manipulated by people with enough capital to move the needle. That's not decentralization. That's just a new oligarchy with better technology. In the stock market, we fear insider trading because it destroys fairness. In Bitcoin, we call it early adoption. The result is the same. Power concentrates, and those who arrive late pay the price. By 2025, Bitcoin's code remains pure, but its market isn't. And that distinction matters, because when there are no referees, every player becomes their own regulator, judge, and victim. By 2025, Bitcoin has become both myth and mirror, a myth of digital freedom, and a mirror reflecting every flaw of human greed. Its price, after years of volatility, has surged again, reigniting the crypto fever that once gripped the world. Exchanges hum with activity. Politicians tweet laser eyes. And the old chorus is back. This time, it's different. But history never changes. It only disguises itself. When Donald Trump returned to the White House in 2025, he promised that America would be the crypto capital of the world. He called regulation a form of socialism and signed executive orders rolling back the digital asset rules introduced under the previous administration. The White House even launched NFTs to fund political projects, blurring the line between governance and grift. Crypto markets exploded in response. Billions poured into new projects overnight. Some were legitimate innovations. Others were fraud and designer clothing. It was the same old story. Freedom marketed as opportunity, speculation sold as revolution. Because in the absence of regulation, lawlessness always masquerades as liberty. That's the paradox Bitcoin has never escaped. It was created to free money from control, and succeeded. But what came next wasn't a world of equality. It was a world of absolute responsibility, where every investor is their own bank, every mistake is permanent, and every loss is final. In traditional finance, there are regulators, courts, deposit insurance, and laws against manipulation. If your bank fails, the government can intervene. If an executive trades on insider information, they can go to prison. If someone steals your money, there's at least a chance of recovery. In Bitcoin, there's none of that. The blockchain records truth, not justice. It's perfect transparency with zero accountability. You can see where your stolen coins went, trace them to the scammer's wallet, watch them move through mixers and exchanges, and still have no way to get them back. The ledger is honest, but the world around it isn't. And that's what makes Bitcoin so haunting. It's not that the technology is broken, it's that human nature doesn't run on code. The crypto community often responds with a simple defense. Don't trust, verify. Store your coins in cold wallets, use hardware ledgers, control your keys, not your exchange. And they're right. If you have the knowledge, discipline, and resources, you can protect yourself. But that's not financial freedom for everyone. That's financial survival for the few. The average user doesn't want to manage private keys or memorize seed phrases. They want safety, not sovereignty. And that's where the entire dream begins to fracture, because freedom without protection doesn't liberate the masses. It isolates them. Meanwhile, the divide between Bitcoin and the rest of the crypto space has never been clearer. Bitcoin remains the most decentralized, secure network in history, but it's surrounded by projects that mimic its language without sharing its integrity. As Bitcoin rose, a new generation of coins appeared, thousands of them, each promising faster transactions, new blockchains, decentralized finance, metaverses, NFTs. The movement became a frenzy. The word crypto was born, and with it, confusion. Thousands of coins promise riches or a revolution. Most vanish within a year, and when they fail, the damage always spills onto Bitcoin's reputation. Because to the average person, it's all one and the same, a blur of scams, hype, and volatility. But they're not the same. Bitcoin was built as digital gold, slow, scarce, incorruptible. The rest of crypto built a casino around it, and as in any casino, the house always wins. Yet the problem isn't just the scams or the greed, it's the system itself, or rather, the lack of one. In 2025, global regulators still can't agree on how to treat digital assets. Some countries ban them, others tax them, others simply ignore them. There's no international standard for exchange transparency or consumer protection. And without a referee, the whales, the invisible few who control the most, keep playing both sides. That's what makes Bitcoin such a fascinating paradox. It removed the gatekeepers, but didn't remove power. It only changed its form. In place of central banks, we now have central holders. In place of policymakers, influencers. In place of oversight, algorithms. It's still hierarchy, just rebranded as decentralization. The truth is, Bitcoin did something extraordinary. It proved that money could exist without a state. It showed that trust could be built on mathematics, not institutions. It was the first successful rebellion against financial monopoly. And it worked. But every rebellion faces the same test. What happens after you win? Freedom without structure decays into chaos, and chaos eventually demands new rulers. Bitcoin has outlived its critics, its bubbles, its crashes, and its imitators. But its greatest challenge isn't technological. It's moral. Can a currency survive without laws? Can a global market exist without accountability? Can freedom sustain itself when everyone's incentive is self-interest? The answer is still unfolding. Bitcoin doesn't need governments to survive, but societies still need laws to function. Without them, financial power just migrates, from parliaments to protocols, from bankers to whales, from regulation to code. Maybe that's why Bitcoin's true legacy isn't financial at all. It's philosophical. It forces us to ask what money really is and whether we can ever separate it from power. Because even in a stateless world, power doesn't disappear. It just finds a new address. Bitcoin fulfilled its promise to create money beyond the state. But in doing so, it revealed a deeper truth. When you remove the regulators, the powerful don't vanish. They just change wallets. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.